Hello and welcome to this Global Derivatives webinar. I'm Ed Stapley, Editor-in-Chief for the Global Derivatives Conferences. Today's topic is diversifying cyclicality risk of quantitative investing strategies. We'll be live tweeting this webinar, so you can join in the conversation on Twitter using the hashtag GDWebinar. So today I'm joined on the line with Artur Sepp, who is Director and Senior Quant at Julius Baer Group. So welcome to Artur. But before I hand over to Artur for his presentation, I'd like to remind you that we'll be holding an interactive Q&A after the presentation. So I encourage everyone to please send through their questions throughout the presentation via the dialog box on your screen. Throughout the presentation, do send in any questions you have, and at the very end we will be asking Artur some questions. So it's a good opportunity to be interactive at the end of the talk. So it's now my pleasure to hand over to Artur, who will go through his slides now.
Yes, good. Thank you, Ed. So good afternoon and welcome to this webinar. So today I will talk about diversification of quantitative strategies. And to start the presentation, I will use some quotes from a very good interview from a person who worked for infamous hedge fund LTCM. So, and in some sense, I share the same experience that it is true that a lot of strategies are well known, and it's probably difficult to find edge in discovering something new that can be sustainable. And but the key problem in investment that say you have a strategy that generates you signals, and you have a lot of strategies that generate different signals. Then how do you allocate money to these signals? So that's the point that usually is not very well covered in literature, right? And that's the point that is important in practice is important. So today I will be talking. I will mention very popular strategies. We consider very popular strategies like equity bond carry strategies, volatility strategies, and trend following strategies. And what we do, we analyze the risk. What is the risk inherent to these strategies? And then we consider two allocations, two type of approaches to allocate funds to these strategies. The first one is when we are trying to dissect market cycles, which are favorable for these strategies. And in the bottom-up allocation, we are just try to project P&L of the strategies and find an optimal combination to mitigate the risk. So in today's presentation, again, I'm not going to consider any fancy strategies. Today, I focus on carry strategies and equity bond carry strategies and volatility carry strategies. And these strategies are very well understood and popular among investment society. And also, what is good about these strategies is that you can compute expected values and also volatilities, like expected volatilities of these strategies. And usually we can do some kind of risk parity allocation or maybe mean variance allocation. So it's within the strategy class, we know how to allocate money. The drawback of these strategies is obviously negative skewness. That typically these strategies, they have very long periods of very good returns, but then suddenly they have drawdowns, very sharp drawdowns. And also drawdowns almost always occur in bad market cycles, in bad regimes. And also they have cyclicality risk to economic and market cycles. What is the next type of strategies is a trend following strategies. They're also very popular, and there are very good papers from CFM and from IHL that that they literally backtest like 2 centuries of using these strategies, and actually they say that it's anomaly. It's over long time periods, it produces positive returns. So again, nothing very fancy, all very well known and tested. What advantage of skewing of trend following strategies is obviously they tend to have positive skewness, and potentially they can have positive convexity, meaning that they have good timing of gains, that you can gain during market turmoil. And also they have limited exposure to economic cycles. The only drawback of these strategies may be that they have tendency to underperform over extended periods of times. And also sometimes it's difficult to define, are you looking for long-term trend or short-term trend? And difficult also to do allocation, because you want to separate signal, like sign of signal, from position size. So now what is also important to analyze, what is actually, when I talk about cycles, what do I mean by cycles? So in market, we usually have at least 3 identifiable cycles for any market. A cycle with low volatility, a cycle with mean reversion when we go maybe from bottoms to tops and from tops to bottoms, and the trend when we have clear trend with relatively small volatility. And obviously these strategies have very cyclical kind of cyclical risk, that volatility, that carry strategies, they tend to outperform in low volatility regime. And volatility carry, there are different ways to build volatility carry strategies. The way I do it, and I think it's appropriate way, is to bet on mean reversion, to make it more sensitive to mean reversion, where kind of you expect that realized volatility will converge faster than implied volatility. And finally, the trend obviously it outperforms in good cycle with strong trend relative to volatility. So now, what is next important, and what I will do, for example, in this presentation, is how do we build infrastructure to backtest and to trade with these strategies. So it is important that when we design or when we implement them in computer language, that they have all common interface, that they can be triggered, like mark-to-market, rebalancing rules. And also then we have a bunch of strategies, and then we classify them by classes. And for each class of strategies, like I can have 10 following strategies on multiple assets, I create a general budget, which will be consumed by these strategies. And allocator should be kind of strategy specific, right? For carry strategy, I use one allocator. For trend following strategies, I use another allocator. But then on top of that, we have a master portfolio that tries to tactically allocate among different classes of strategies. And then we can mostly, I think, the purpose of creating this type of master portfolio, that you can try and play different strategies, even without like letting strategies do their own work. You just control how much money they can get. So now we talk about cyclicality risk. So again, cyclicality risk, probably the most important risk is that strategy can enter extended period of underperformance. That so for this particular example, say short straddle strategy, when we sell delta neutral straddles, at the beginning they're delta neutral, but we don't hedge them. So obviously when market trends too much, we are not performing well. And for many strategies, we have similar cyclical pattern, because usually strategy is always conditioned to some particular risk factor, right? And when that risk factor has significant importance, the strategy may underperform for extended period of times. The second is skewness. As I mentioned, carry strategies, they tend to have negative skewness. And the way we see it, that negative returns are more likely than positive returns. And the final one, so here it's good to see long-term perspective. What is the skewness of different strategies? And obviously, the most exposed strategies with negative skewness are kind of at the like straddle selling or dividend strategy, dividend ETF. They have negative skewness. All carry strategies have negative skewness. That they generate small returns, and during turmoils they lose a lot. Whereas the assets with positive skewness are indeed CTA type of strategies. So on the right side, I have CTA index of 50 largest CTA funds, and also bonds. So bonds and dollar. These are assets with positive skewness. And the idea is to mix strategies with different skewness profile. So to have overall, to have positive, maybe positive or not significant skewness risk. And the last one is convexity. So convexity being that so for that strategy has much too exposure, negative exposure to large movements in the market. The typical example is straddles, right? You always lose. You lose if market goes down, and you lose if market goes up. And the timing of your losses is always bad. I mean, especially when market goes down. It's maybe less bad when it goes up. So since I wanted to talk more about volatility strategies, is my specialty. So usually, right now they are very popular, but actually, what people a lot of what I see, a lot of strategy, what I see, they are not selling volatility, they are selling premiums, right? And so here is a particular example of just selling strangles, out of the money strangles, and buying some also deeper out of the money strangles to protect tails, right? And usually the strategy performs well. It has relatively good sharp. It has some periods when it performs very well, especially going from drawdowns, like in 2009, it performed very well, because again, the conditions are more, the strategy, volatility strategy benefits from periods of mean reversion. It doesn't really benefit in low volatility regimes. And yes, and obviously it has large negative skewness. It has also negative convexity. Whereas proper, so there are many ways to improve it, to improve naive premium selling. And to do volatility selling, so here I have a time series model which is actually trying to replicate price, option value, by looking how much that is going to hedge, what are the hedging costs, right? So if I can realize that, and strategy also give me replication strategy, like my delta, it computes my delta. And so, and therefore, I can actually do relative value. So I only sell when relative value is high enough for me to realize P&L. And so I have this strategy with filter plus delta hedge, and filter alone, it improves sharp. It doesn't really improve skewness. It reduces convexity though. That the strategy is not all the time in the market. It's just trying to find the good opportunities. And but with proper delta hedge, then obviously it becomes neutral, effectively neutral to the market. There is no convexity. There is a relatively small skewness risk. So I think this step must be, for any carry strategies, this step is crucial. First, you need to design a filter, that it must be a relative value filter. No matter you do some dividend carry or maybe some fixed income carry, always important to have some filtering mechanism on the strategy level. So next, I consider trend following strategies. What is important, because my particular design of these strategies, because we are mostly trying to trade in cash, stocks, large cap ETFs, fixed income ETFs. So for me, it was important to design, if I wanted to hedge my carry portfolios, volatility portfolios with trend following, I need to have the same components. So while traditionally CTAs, they are looking more into commodity, they work across many different asset classes, but maybe not particularly on stocks and large cap bond ETFs. So there is some kind of, I agree that CTA provide uncorrelated market return, but maybe in periods of, say, 2008, you need something that actually you know that is going to work in your favor. So here I designed some strategies using the same type of CTA type of approach. So usually in CTA, there's a very good paper from IHL Quant. So, and what they discovered that in CTA we need to construct a signal, and signal usually we can use some past returns to project like expected forward returns and build signal on that. And what they discovered that usually in this type of strategies, factor loadings have this quadratic shape, that the signal is strong either on recent history or on history maybe from 9 to 11 months. And what I also found interesting that so this system gives you a signal, but actually what is it doesn't give it. Another question is how do you size position, and what I found interesting that we can do some option replicating. So for a long signal, if I get a long signal, for me it can be equivalent as I sold call. So if the trend continues, I need to buy more and more delta. And in opposite, if it starts to go to reverse, then I need to sell my delta. This type of, I found it interesting, and it works. So here I show example of, and usually CTA type of models, they use monthly signals. And so in this example, so I use ETF on S&P 500 and bond ETF. So we see that indeed the strategy generates nice convex profile that is able, not always, but more likely than not, is able to provide some tail protection. And the same is for bond. And obviously, it has relatively good skewness. If, say, for S&P itself, the skewness is minus 1.4, strategy has almost zero skewness. So it's indeed, it helps us, if we use trend following strategies as tail protectors or some kind of strategies that help mitigate skewness in other strategies. So that's the advantage of these strategies. So in next example, the last example, dividend and equity bond strategies. So again, there are many ways to design these strategies, and maybe I think the most which I use in practice is using some fundamental indicators, some sort of smart beta. But let's say, for sake of simplicity, we can also use ETFs to build strategies, this type of strategies. So here I just use three type of assets, like equity carry that has dividend and real estate ETFs, and fixed income carry that just using some bond ETFs, US bond ETFs, and also credit high yield, using credit bonds and high yield and emerging markets. And so the first, and there are obviously many ways also how to allocate within this strategy. So if we use equal weights, you see we have still a concave profile, meaning that if market goes up too much, we expect to underperform. If it goes down, we still have negative convexity to large moves. And this is very typical. For carry strategies, this profile is very typical, that convex profile, concave profile, that you lose a lot on the downside, and you are not performing very well on the upside. You only perform well in the middle when market doesn't move that much. And then also, because here, in this particular example, I have assets with different characteristics. And for particular treasuries, they always help to mitigate some deflation risk. And others, like high yield, it is more likely in stocks. They typically suffer in strong deflationary scenarios with high risk aversion that we saw in 2008. But actually, using even on this strategy level, using some risk parity allocator improves the convexity profile. And actually, if the equal weight strategy has negative skewness of minus 0.6, the strategy with risk-based allocation has already positive skewness and also smaller drawdown. So again, at this level, once we ensure that strategy itself is able to kind of pick up, has a filter, the next step, what we can do is to have some risk-based allocation, just to try to use a very simple volatility or covariance matrix, just to try to minimize the negative effect when strategy starts underperform. Right? But this is not the end of story. So now we have a master portfolio. And the master portfolio, so in this particular example, I wanted to show example of constructing this type of master portfolio. So on the bottom, we are going to have three strategies. Volatility carry strategy designed in the same way that I presented before. That it has a filter and it has a delta hedging mechanism. And we apply it for 9 large cap ETFs, sector ETFs. And the equity bond carry strategy is the strategy that I presented just before, and the trend following strategies that uses monthly and weekly signals. And so each strategy has its own rebalancing, like risk allocator, but on top we have a master portfolio that will try to dissect market regimes and also try to do tactical allocation. And I practiced this type of master strategy since 2005. The striking example, so you see, so now the static master with just, it's using constant allocations to all the strategies, not changing anything. It has already relatively, it's a good Sharpe ratio. It has relatively mild skewness, even though it has different, it has dividend carry and volatility carry strategies, but trend helps to mitigate the negative skewness inherent in that strategies. And we see that even when we just do static combination, right? When we just put together strategies that perform differently in different regimes, overall we get a good risk profile. And at the same time, when we tactical master, so we always, as I mentioned before, say for example, dividend carry always works in regimes with mild volatility, with small volatility. So here we have models that anticipate the regimes, and based on that predictions, we make overweight or underweight allocations to these strategies. And now we see it's actually we are able to improve Sharpe and also reduce skewness. So the moral of the story that even if we have strategies that we understand that are going to perform differently in different conditions, and we put them together, we get improvement. We get material improvement in overall performance. And on top of that, when we try to do some tactical allocation, just trying to predict conditions for these strategies, when the strategies outperform and put more, we get even further improvement. And the final two slides, I wanted to estimate, so the construction of portfolio presented before was top-down. Actually, master portfolio doesn't need to know anything about underlying strategies. It just allocates money, it just knows the conditions where the strategy perform and allocate money. In bottom-up, we are trying to project strategies P&L. So bottom-up is more for tail hedging, right? When we try to perform bottom-up simulation of strategy P&L, and we're trying to discover the tail risk. So we have some maybe risk factors. We try to simulate market scenarios. We try to project the P&L of the strategies, and we try to see what is my convexity, what is convexity concavity profile. So actually, using this example is the best to explain. So what we have here is three strategies again. But say I'm trying to run strategy on fixed income that I sell some volatility. So I have this blue line is concave profile, right? I always lose when rates go up or down too much. And on top of that, I have a dividend and rates carry. And rates carry obviously benefits if rates goes down, right? So I have also convex profile on the downside scenario. While obviously I will be exposed if the rates goes up. But in that case, I can do CTA type of strategy on financials, right? And they obviously, more likely than not, they are going to be correlated, financials with rates. So I actually building up some protection for upside spike in rates. And overall, these dots, you see that I'm actually hedged. So I can use my carry strategies along with CTA type of strategy to cover my tail risk. And finally, so to conclude, so I think what is important, so again, what is important is three things. First thing is to ensure that each strategy has a positive expectancy, that it has some sort of a filter. And second, to understand what is actually a strategy, in what regime the strategy is likely to outperform. The second step is to build an allocator for the same strategy classes like carry or CTA type of strategies. And the final step is to actually have a portfolio of strategies that tries to either build a static allocation or do some regime forecasting and do some tactical allocation and also do some tail hedging. Thank you very much.
Okay, thanks very much for that presentation, Artur. Very interesting stuff. If you haven't already done so, do please submit your questions now via the Q&A tab. You may have been thinking about some questions earlier on in the talk, or questions might come to you as you hear other questions, but we've got a little bit of time now to have some engagement with Artur whilst we've got him. And I guess I'll start off with a question. So Artur, what would be the current indicative allocation between carry, vol, and a trend following strategies?
Mm-hmm. Thank you. It's a good question. So right now we are in a regime with low volatility. In this regime, carry strategy is expected to outperform, and therefore it should be overweight carry strategies. For volatility strategies, again, as I mentioned, people, usually the solutions that I see now, they're actually not selling volatility, they are selling put premiums. So it's also some type of carry strategy, and this volatility premium selling, they had a good run. People are very excited about it, but for proper volatility selling, you need mean reverting scenarios, some kind of dislocation scenarios. Last time it was very good in December, January in fixed income. Because of Trump rally, fixed income, there were very good opportunities, but not now. And for trend, I think it's a little bit risky because the trend right now, I think for past few months, low beta, high dividend, they outperform. And for a lot of strategies, a lot of carry strategies, these stocks or bonds, they will be over allocated to this low vol, high yield, this type of portfolios. And obviously in trend following, you don't really want to get too much of that overlay. So to final answer, overweight carry, underweight vol, and trend following.
Great, thanks, Artur. Some good questions coming in here, so I'll go straight to the next one. Do you use option implied information to infer probability of regime?
That's a good question. You can do, but in my application, no. It's actually on my to-do list is to have a regime. So as I mentioned, I have kind of relative value for option trading, for volatility trading, and I have like a statistical model also to infer regimes. And one of my to-do topics is actually to combine, to estimate premium, option premium using regimes, kind of the size of the premium. And actually I did something similar in past for credit, and I saw that a lot of actually premium comes from being exposed in bad regimes, because credit strategies, in some sense, they are very similar to volatility strategies, that you get very small coupon in exchange to suffering losses in bad regimes. But when we enter, say, turbulent regimes, you also have mark-to-market losses because spreads widen. And therefore, actually, a lot of premium, and there is what is called credit spread puzzle, that apparently credit spread is higher than realized default in past. So there is obviously there is some risk premium for you to suffer losses in bad regimes. And actually, what I saw in that model, in that regime switching model, that actually I had the significant, that this risk premium was significant in stress regimes. So, and I think it's very interesting for modeling purposes to understand what is actually, what compensation you receive. It's a good question. Thank you.
That's great. Thank you, Artur. Another question here. Could you expand a bit more on relative value filtering for vol carry strategies?
Mm-hmm. Okay. It's a good question. So So implied volatility, people understand, they always think, oh, okay, Black-Scholes formula, right? So Black-Scholes formula gives you option value, but also one of the significant or contributions of Black-Scholes was actually that you can also, by doing dynamic hedging, you can replicate that value, right? You can arrive to that value. And obviously Black-Scholes is based on some assumptions, some log normality assumptions and some continuous trading assumption. So while in practice, this assumption, they don't help, right? When you sell option and you try to replicate it, we always face a risk of gaps that can be some periods, say overnight gaps, we cannot hedge. There are transaction costs, right? There are some cyclicality that there will be periods of very high volatility when it's difficult to hedge. So everything, if you have a model to do that, you can arrive at different value, right? A different value than the Black-Scholes. And what volatility premium means, usually skew premiums, is some kind of manifestation of that effect that in practice it takes much more, or the cost of replication are much higher than the Black-Scholes predicts, right? And therefore, if you have a model, a good model that gives you actually the statistical value of your replication strategy, and you compare what is in the market, you can see opportunities. Right? You can generate signals using this model.
Okay, yes. That sounds great. Thank you, Artur. Another question here relating to slide 8 of your talk, and that is, what is the maturity? What maturity is the short straddle strategy in slide 8? There was a slight surprise that the strategy had stalled for 6 years.
For this 1 month, I recommend for volatility strategies. For short volatility strategies, I recommend between 1 and 2 months. Actually, I did myself like extensive testing. Actually, using some like not much of backtesting, but more conceptually. That is turns out is the best, because if you go longer dated, you take too much Vega risk, and it's difficult to say whether it's compensated or not. If you too much short dated, it's too much gamma risk that you always, it's literally collecting pennies and in front of steamroller, whereas more or less 1-2 months is optimal. And all of these strategies that I showed here is 1 month. Thank you.
Thank you, Artur. Another one here. How do you reduce cyclicality risk? Do you forecast cyclicality regimes? How do you forecast it and hedge it? Do you use Markov models? A few questions there to have a think about.
Yes. So in this example, I use Markov models that have different regimes, and I'm inferring these regimes, and I'm like also you can forecast. I think the most important for me is always forecasting ability, not much of kind of saying what was yesterday. I'm more interested in predicting what is going to happen tomorrow. So while I like these models.
Great. Yes. A couple more questions before we wrap up. First one here, how sensitive are the results to the regime identification?
Well, it's a good question. It's actually a great question. And it always, I was curious myself, actually, is it possible how much I'm sensitive? So it's exactly in this final slide, right, that you see that for static allocation, when I just combine strategies that have different performance in different regimes, and I'm already kind of really, I'm good hedge. It's a good performance by all means, right? And obviously, when I try to do some tactical allocation, right, so some shifting money in and out. Also, it's important that usually these strategies that I presented, they have monthly rebalancing. So you always have some kind of, it's impossible to say, and I never try to do that to be too much aggressive in kind of cutting positions. I rather do it to kind of like in steps, right? So yes. So if you are able to forecast it, then yes, you see it helps you. It helps you further. But I think the underlying case must be that you have a basket of strategies that you know are going to perform differently in different regimes. Thank you.
Thanks, Artur. So the next question is, isn't risk premium size model dependent for options?
That's a good question. Is a model? I think, yes, and I know the answer. Yes, it's model dependent. One of the like when you design these models, you should always check. So I have this relative value model, right? I can know if I have enough history, especially of life strategy, I can actually check was the prediction good or not, right? So this is one of the things that you should do, whether model actually gives you like based on history, does it gives you a good value or not? Because obviously, I mean, option like replication strategy, when you do like kind of estimation of model value, right? You always estimate kind of hedging cost, and it's difficult to say historically. We don't have much of a history, right? It's always question: is my model good or is I'm just lucky, right? And you to try to avoid that, you should do kind of back testing not only on P&L but also on predictive ability of your model. Thank you.
That makes total sense. Thank you, Artur, for your time. That's all we've got time for, I'm afraid. But those questions we did not get through. We will pass them over to Artur, and then we'll share his answers with the community. So stay tuned for that in the next few days. So that just leaves me to say thanks again. Thanks for joining us, Artur. Thanks for your time.
Ed, if I can make a final remark. Yes, I have a longer slides of this presentation that I put on SSRN. So if you are interested in more details, you can find them there.
Perfect. Well, there's some great engagement, definitely for the questions, and we'll be able to connect you with any further thoughts there between those who are listening and engaged. So for listeners interested in other content, do visit our URL on your screen now to view more content from other thought leaders, including sort of previous webinars and interviews. And if you've got any feedback on today's webinar or any recommendations for future webinars, please do complete our short survey that will flash up on your screen shortly. So thanks again, Artur, and goodbye to everyone who tuned in.
Thank you for joining me. Thank you.